In this video, we will discuss the BRRRR investing method and learn how to implement it correctly. BRRRR investing is a real estate investment strategy that stands for buy, rehab, rent, refinance. The goal of this strategy is to generate cash flow and build long-term wealth through the acquisition and renovation of distressed or undervalued properties. After successfully rehabilitating a property and renting it out, you can take out the increased equity through a refinance and acquire another property to repeat the entire process. Here's how the BRRRR investing strategy works. Choosing the right property is essential to the success of your BRRRR investment. You should look for properties in desirable neighborhoods with strong rental demand. You want a property that will attract good tenants and generate a steady stream of rental income. Also, you should opt for properties that only need cosmetic updates rather than major structural repairs. You don't want to invest in a property that requires significant repairs or renovations, as this can eat into your profits. However, make sure that the property you choose is priced below market value. You want to buy the property at a discount to leave room for renovation costs and potential unexpected expenses. Always keep in mind the property's after repair value, which is the estimated value of the property after the renovations are complete. You want to make sure that the after repair value is higher than your purchase price and renovation costs to ensure a profitable investment. This is also important since the amount of equity which you can later pull out through a refinance would depend on the property's appraised value after repairs. When you have already chosen a property, it's now time to buy it. Usually, in BRRRR investing, short-term loans such as private money, hard money, or a home equity loan are usually preferred since such loan will be replaced with another loan with more favorable terms later on through a refinance. Once you have purchased the property through any of the financing methods mentioned, it's now time to rehabilitate it. As we have said, your after repair value should be substantially higher than the property's market value, plus renovation costs. Keep in mind that banks will usually refinance up to 75 to 80% of the property's appraised value. So, if you borrowed 600,000 pesos to buy a property and spent 150,000 pesos to renovate it, the after repair value or appraised value you should aim for in order for you get back all the money you spent in acquiring the property should be at least 1 million pesos. After the property is renovated, it's now time to rent it out at a rate that is sufficient to pay down the mortgage and cover ongoing expenses. You should also aim to maximize your net operating income since this metric is used as basis in determining your property's market value. So, the higher the rents and the lower the expenses, the higher the net operating income and the property's market value. Remember that an increase in the property's market value will also mean an increase in your equity, which you can later on pull out through a refinance. Once the property has been stabilized and is generating consistent cash flow, the investor can already refinance the mortgage and pull out equity that can be used to reinvest in more properties. However, always remember that loans usually have a seasoning period before they can be refinanced. A seasoning period refers to the amount of time that must pass before you can refinance a property. In BRRRR investing, the seasoning period is an important consideration as it can affect your ability to pull out equity from the property. Usually, this seasoning period ranges from 6 months to 1 year. If you have done your math correctly and successfully attained your targeted after repair value, then you can get back all of the money you spent in acquiring the property while maintaining equity and earning rental property from it. At this point, you can repeat the process and reinvest the money you have just taken out and implement the BRRRR method once again. By repeating this process, the investor can build a portfolio of rental properties that generate ongoing cash flow and appreciate in value over time. However, it's important to note that BRRRR investing can be a complex and risky strategy that requires significant research, due diligence, and capital to execute effectively. So, there you have it. The basics of the BRRRR investing method, which you can use to acquire multiple properties with no money down or with substantially less cash. If you have questions or comments, please leave them down below. Thank you for watching, and please don't forget to subscribe.